Good morning, everyone, and thank you for joining us today for the full year results with UPGS Ultimate Products. We're joined today by three directors. We've got Andy Gossage, MD, who's going to kick off, and then we shall hear from Graham Scrawn, Financial Director, to cover financials, following with Simon Showman, the CEO, who will give us a strategic and update piece. This is being recorded, so you can watch back at equitydevelopment.co.uk later on today. We have released a new note this morning as well, so if you would like to see forecasts, you can find that on our website. Otherwise, gentlemen, over to you.
Great, thanks Hannah, and thanks everyone for your time today. Really appreciate it. We'll go to page 3, please, Hannah. So many of you I know are familiar with the story, but there's always a few who were new. So I'll spend a minute or two just explaining who we are and what we do. So we are a branded consumer goods business. We are based up in the northwest in Oldham, established in 1997 by Simon Showman, the CEO, who will be speaking a bit later on. And our mission is beautiful products for every home. So we want products that people can be proud to have on their countertop, but we want it in a price range that's affordable for everyone. So I always say to people, if you see us in John Lewis, give us a call, because we've probably gone wrong somewhere along the line. And what we do is we pitch our we give the consumer a branded product at price points which is on or just above the sort of own label price that you might see in a supermarket. And what we in turn offer to the retailer is a proposition that means that they can give their consumer a branded offer, which is what we believe the consumer wants, but they can make their full retail margin. Other brands, for example, would be much meaner. So that's our proposition, which is we believe is fairly unique. We have on the panel in the middle a selection of our premier brands. We do have others. Beldray is our biggest brand. Beldray we sell on laundry and on floor care. It dates back to 1872. And when we bought Beldray back in 2009, it was turning over about £500,000 a year, and in FY20 it turned over 30 million. So we've done sort of fantastic things with that brand, and we hope to do a similar thing with Progress and Clean Easy, which I'll come on to later. Salter is a licensed brand, so we don't do the scales, but we like pretty much everything else you see under Salter is Ultimate Products. Again, great brand, great British heritage brands from 1760, and that's our second biggest brand. Russell Hobbs, again, we don't do the electrical. We license this brand for cookware. Again, great British heritage brands with strong recognition, and I say we have that brand. That's our third biggest brand. Intempo is an audio brand aimed at teenagers and just above, really kind of sort of pocket money audio and tech products for that demographic. And then we have our two more recently acquired brands, Progress and Clean Easy. Progress is a Lancastrian bakeware brand originally. We've developed this into a wider kitchen brand for cookware and also for kitchen electrical. And Clean Easy, much better known because of the catalogues. We bought this a couple of years ago out of administration, and this is really like Beldray, a floor care and laundry brand. And we've got some big plans for those, which we'll come on to in a few minutes. 6 major product categories: small domestic appliances, housewares, audio, laundry, heating and cooling, and luggage. But I would say going forwards, the bulk of the growth is coming from, and we expect will continue to come from, the big three, which is SDAs, housewares, and laundry. We employ over 250 people across the group. Headquartered, as I said before, in Oldham, but we do have a sizable sourcing office in China of about 40 people, and that's where the vast bulk of our product is sourced from. And we also have a showroom and sales operation in Cologne in Germany. Germany being a key target market for us over the next few years. So we go on to page 4, please, Hannah. So Graham is going to talk at greater length about the numbers a bit later on. I wanted just to pick out a few things up front. Obviously, it's been a challenging year in lots of ways, and we would have expected to see revenue growth. In the end, we saw a relatively modest decline in revenue in light of the challenges that COVID brought during the year. But I think what I'm particularly pleased at is that revenue dropped 6%, but profitability only dropped by about 3%. So we were able to mitigate a large part of the impact of that, and Graham's going to talk through that when he comes to his section. Fundamentally, it's down to our EBITDA margin has improved, and that was I think the second year that improved. And what we've been able to do as a business is, as we've diversified away from our sort of discount origins into areas which are maybe deliver a higher gross margin, but also often come with a higher overhead requirements. We've been able to mitigate those overheads by focusing on productivity and focusing on our operational capability, and particularly in the area of online. We've been able to build in quite a lot of capacity during this year, and also quite a lot of efficiency along with that. We've also seen a big drop in our net debt, down from 14.4 million to 3.8 million. Graham will go into the detail of this, but we have seen good, strong, tight control of working capital as we've gone through this year, and particularly helped, I suppose, by strong demand for stock during the lockdown and as non-essential stores reopened. That's also reflected in strong headroom within our facilities. We are very financially strong as a business, and that gives us that high level of headroom. I think gives us confidence, because it's going to be, the market generally is going to be challenging for some time to come, until this virus is brought under control. And also it gives us opportunity, I feel, as well. Those of you know us well know that we acquire brands opportunistically, and in order to do that, you need to have the financial firepower to be able to move very quickly, and certainly having 21 million of headroom is a fantastic position to be in. We did during COVID, we did postpone our interim dividends. That was reinstated and paid in October, and we've declared the final dividends, and we have a stated dividend policy of distributing 50% of our profit after tax each year. And after a momentary pause, we've been able to return to that policy for FY20. So we go to page 5. So operational highlights. I guess the first item on the agenda, of course, is COVID. It's been quite a year, and it seems to be continuing. Huge challenge. We saw it quite early on because of our China operations, and we were dealing with those supply chain challenges, I think, very effectively, with only a sort of moderate impact on expected revenues. But then, of course, the virus came to Europe, and it started to have a demand side impact with lockdowns and store closures. And again, because of our European business, we saw this earlier than most, and we were one of we warned on this on the 19th of March, and at that point forecasts were withdrawn. During this period, the first priority has been, as you would hope, the safety of our colleagues, particularly in those early days when less was known about this virus. And we have put in place as a business numerous measures to protect our staff. And what I'm particularly proud of is the fact that we've not seen any on-site transmission of this disease, despite the fact our distribution centre has remained open all the way through, and in the last few months, so was our office. And I think that that's a real credit to our site and HR team who have done a fantastic job of putting in these safety measures and various protocols. And I think more notable, because Oldham, of course, as many of you will know, is a COVID hotspot. So that's something that we are very proud of. Back in the spring, we took all the obvious measures to protect the business, with a big focus on preserving cash. So we put on hold all capital projects. We stopped any discretionary expenditure. We made use of the government's VAT deferral and time to pay initiatives. We extended our bank facilities. We didn't think we needed to, but we did it on a precautionary basis. And as I mentioned before, we did suspend the interim dividends and also initially claimed on the government's furlough scheme. So we pulled all those sort of cash levers to give ourselves the best chance going forward. In the end, our profitability and cash flows were stronger than we expected during lockdown. The months that where our revenues did fall during March, April, and May relative to the year before, but those months stayed profitable, and we also stayed cash positive. So we reintroduced forecasts in April, quite early on, and that led to upgrades in June and July, and then indeed a further upgrades when we did our pre-close. This enabled us to repay all the government help. So pre-year end, we repaid all the VAT and the PAYE that we had deferred. And then post-year end, we repaid the $500,000 of money that we claimed under the furlough scheme. Okay, moving on to online, and it's linked to the COVID points. Online has grown very rapidly for us over recent years. Going back to when we IPO'd, it was less than 5% of revenue. We had a target on IPO of growing this to 20%. Lockdown did act as a bit of a boost, because a lot of non-essential stores were closed. And for the year as a whole, we're up 47.2% for FY20, with the share of overall revenue at 14.5%. So getting closer to that 20%. And indeed, if you look at the second half, it was nearer to 19%. So we do feel we're pretty close to that target that we set ourselves in IPO, and at some point we will be setting ourselves a new target. Like online supermarkets had a good lockdown, I suppose. They remained open. Again, it's a segment that we were growing rapidly anyway, and revenue for FY20 was up nearly 40% on the year before, and it's now nearly a quarter of revenue, which is really a substantial change in the mix since we IPO'd in 2017. And what we're seeing, and Simon will touch on this later, is as we move into Europe, we're often going to the supermarkets first rather than the discounters. International, again, another big change since IPO. Where when we IPO'd, it was more of an aspiration than a near-term strategic objective. But what we changed that back in 2018. We very much put it on the top table in terms of our priorities, and now it's a much bigger part of the overall sales mix. Now, you will have spotted, no doubt, that we did see a drop in turnover. So in FY20, which may look disappointing at first sight, but there are a couple of factors to bear in mind. First of all, one of our biggest customers over there is Action. Action was deemed a non-essential retailer and was fully closed during the whole of the lockdown period. So that had I suppose, a disproportionate effect. And we did generally see our discount customers, not all the time, but in the main, tended to be more affected by the lockdown rules and more likely to be deemed non-essential. We also had our biggest customer in Germany, which was a subsidiary of a UK parent, went into a strategic review. So we had to stop supplying it at that point, and then was subsequently sold. So we have recommenced supply with that customer, but for about 6 months there, we weren't supplying that customer. If you look at Germany and you take out the effect of that, and Germany's our main target market, we were up nearly 50% in the year. So we can see, which might not jump out of the numbers, but we can see really strong progress taking place within Europe and particularly within Germany. Moving over onto the next slide, page 6. Now, talent. Those of you who followed stock will recall that we plan to invest in our office working space up in Oldham. It has kind of reached the end of its life. It's a drafty, those of you who've been up, and I think some of you have, it's a bit of a drafty old mill, an old cotton mill dating back to 1900. And we found it sort of increasingly not suited for what we needed it for. So we made a decision over a year ago now to invest in the workspace, and that is we had to defer that because of COVID, but we've now recommenced that. So that planned spend of 1.8 million is starting again, and for us it's really about it's really about growing our talents. You know, we want our we have a talent model which is very similar to the professional services firms, in that we bring a lot of bright, energetic young people in at graduate level, and then we grow them through the business. And what we've seen with that now is we're starting to see some of those people coming through into senior positions. So our head of IT came through the graduate scheme, head of QA, head of online, and our recently promoted buying director for housewares, which is one of our 3 key divisions, came through the graduate scheme. But the key is now really to give them a better workspace, and that's what this £1.8 million investment over FY21 is going to deliver, as well as capacity for the foreseeable future. Product development. Now this was a big one for me and Simon. Most of our competitors, when the crisis started, kind of went into a bit of a hibernation. You know, they typically furloughed their sales and buying teams and decided to wait it out. We kind of swam across against the tide on this, and we decided to continue to invest in product development. And we were able to do that because of our boots on the ground in China. So our UK buying team have not been able to travel to China, some of them for 12 months. But they were able, through our colleagues in the Guangzhou office, we're able to keep that product development cycle going. And that's meant we've gone into autumn winter 20 with a refresh range that retailers have responded positively to, and which they've not really seen from our competitors. At the same time, we kept our sales team in work, which, you know, again seemed counterintuitive at the time. They weren't taking any orders, so why keep them in work? But we decided that we wanted them talking to our customers throughout the lockdown period, maintaining those key relationships in anticipation of when stores would reopen and they would start buying again. And I think this investment in product development and in our sales team has really provided a strong commercial platform going into FY21. And that's reflected in the fact that our order book for FY21 is looking very healthy. Brands, this is where I want to sort of return to Progress and Clean Easy. You know, I mentioned before, Beldray, we've grown from hardly anything to a £30 million plus brand in in just over 10 years. We've learned a lot along the way. And what we want to do with Progress and Clean Easy is go on the same journey but quicker. And what we want to do is we want to achieve really what we achieved with Beldray in say 6 years, in 3 years. And a key component of this is going to be how we've kind of learned how to market our brands cost effectively, and we're going to deploy that capability with Progress and Clean Easy and accelerate their growth over the next 3 years. Our objective is to bring them up alongside Beldray and Salter in terms of consumer awareness and in time in revenue. Community. Some investors are really interested in the ESG side of things, and that's great. And I would really ask all of you, if you only read one section of the annual report, please read the ESG section. It won't be very often an MD asks you to do that. You know, Oldham, we're very proud to be based in Oldham. You know, but it was pre-COVID one of the most deprived towns in England, and it has been absolutely battered by this disease. And so, you know, we felt that we had to do our bit to help the community. And if you want to read more about that, read the ESG section of the report. But also go to our LinkedIn page, the Ultimate Products LinkedIn page, which has really acted as a journal for all our community efforts during lockdown. It's many and varied, but we've tried to help the NHS, we've tried to help young carers, and also the other charities based in Oldham who at times I think felt fairly abandoned. So please do take a few minutes to look at that. I think particularly if you're a shareholder, I think you'd be proud to see what we've achieved there. Finally, board appointments. We appointed 2 new non-execs. Christine Adshead, who's a former senior partner at PwC, and Jill Easterbrook, formerly CEO of Bowden and various sort of senior positions at Tesco. Jill is also an NED at Auto Trader and Ashtead, which are both FTSE 100 businesses. So we're absolutely delighted to have Christine and Jill on board. And in the 2 or 3 board meetings we've had to date, they've made a fantastic contribution. So they've been great additions to the team. Okay, at this point, Hannah, I'll hand over to Graham.
Okay, thank you, Andy. Good morning, everyone. Thanks for making the time to join us today. Hannah, if you could take us over onto thank you. The income statement here on page 8. So Andy's touched on a couple of points so far. I think highlighting that the revenue decline of 6.1% through the improved margins, the productivity focus that we've given, reduced the impact on EBITDA to a decline of 3.3 and to underlying PBT of 2.7. So, which I think in the circumstances we were very pleased with. One of the key contributors to that was the increase of 90 basis points in the gross profit margin, heavily influenced by the strong growth of online, which we stated before is a higher margin sector for us, gross margin. It does have a higher overhead requirement. In terms of overheads, overall we reduced overheads by 300,000, which was largely reductions relating to COVID cost reductions, sort of, less travel for obvious reasons. Obviously, although Andy said our China team out in our team out in China were able to continue traveling, helping drive the product development, keeping close to the factories. So that part continued. And additionally, things like exhibitions, clearly they didn't take place over the second half of FY20. But On our overheads, around about 2/3 are people-related costs. So that's our key block. we mentioned in the finance report that headcount increased around about 10% over the course of the year on at the average level. But I think it's important to note that by the year end, the closing heads are around about 6% lower than that average level. As you know, we've given a big focus on productivity, invested in new systems in the warehouse to help create and maintain plenty of capacity to deal with the growth of the online sector and to process those orders in a much more efficient manner. And so that's been a key focus of ours. In terms of the exceptional items, usually we just see the share-based payments here, but that does include the credit for the amount claimed within FY20 under the coronavirus job retention scheme. And you're aware that we decided to repay that post year end, but it still has to come through our P&L in the current year, and then you can expect to see a debit on the opposite side as it goes out through FY21. Okay, if we could move then onto the bridge chart on page 9. I think this sort of illustrates the sort of development of the year quite well. Everything else remaining equal, same margins, the decline in overheads would have led to a reduction in profit of 1.7 million. But a large proportion of that was mitigated by the increased gross margin through the changes in mix. So that recovered 60% of that, further added to by the lower level of overheads. And so that as it transpired, it gets to the sort of underlying profit after tax. And the net difference compared to last year was just a decline of 163,000, which I think where we were at the start of lockdown, we're very pleased with that final outcome. If we can move over onto page 10, we've got some of the segmental analyses, which Andy's already referred to a reasonable amount on. Spoke about the geographical side, the decline in international, with two key factors, but highlighting the underlying growth of Germany, excluding that one customer that closed and then subsequently reopened. So without that, Germany was almost 50% up on last year. On the by pillar, Andy's talked about supermarkets and online. I think one of the things that stands out to me is the mix by FY20. Back in FY17, discount were almost 60% of our sales, and supermarkets and online together were less than 20%. So they've now moved to a similar share, around about sort of just under 40% each now. So we're getting a much more balanced mix to our revenue across our strategic pillars. And in the detail in the financial notes, you'll see that our concentration with our top 2 customers is down at 26% this year. Back in FY17, that amounted to 46%. Okay, if we move forward now to page 11, we've got the brands here. I think the key point here was that those brands that were focused in sort of particularly home cooking and cleaning were those that performed well and sort of linked with supermarkets and online. So strong performance through Salter, through Russell Hobbs. Beldray had strong performance in the supermarkets, but sort of its discount exposure pulled that back a little bit. And then just noting in Tempo, our audio brand, which had a challenging year with a combination of tough comparatives and being a sort of a significant sort of share going to the discount sector, where we hadn't suffered from store closures in post-lockdown. Across onto the product slide on 12. Similar pattern again here. You know, the cooking, home cooking, cleaning product divisions, small domestic appliances, housewares, laundry, showing some very nice growth there. But audio again on the back of that very strong prior year, and the impact of closures had a tough result. I think if now move on to the balance sheet away from the P&L, I think as a sort of FD, the key point to note here is balance sheet strength. Andy talked about the reduction in net debt to 3.8 million. I sit here now and still feel that sort of trying to get a head around having over north of 20 million of headroom is a challenge. It's a very nice challenge, but it puts us in a very comfortable position, very strong position, so we can take any opportunities that do come our way. Also, highlighting the strength is the further increase in net assets. So 13.4 million at the end of FY20, going back to just pre-IPO, around about 6 million. So a nice development in the net asset position and supporting that strength you see through the balance sheet. In terms of where the main changes are, I think the focus is working capital. Stock reduction there of 4.4 million coming out of lockdown. The stores that reopened again had a high demand for stock. Online obviously sold very well. So the stock levels I think were impacted through that. Although on the back of that, alongside that, we have had a focus on improving our stock turn to maintain capacity, plenty of capacity in the warehouse for some online growth, for future business growth. So it's had an impact. Obviously, so the lockdown has had an impact. So that the 16 million is certainly lower than we'd ordinarily expect, but we'll expect to see some normalisation of that in FY21, but probably not to the previous levels that we've seen there. Trade debtor days slightly increased, but certainly within our normal range. And trade creditors, we saw some increase there. Certainly not through taking delayed payments. It's from our agreements with factories, with the loyalty that we've developed with them over the years. We've gradually increased payment terms with our factories, and that's helped increase our creditor levels in spite of a reduction in stock. So a very positive movement in working capital there. Just to highlight the net debt was 3.8 million. And as Andy mentioned, all the time to pay, that deferrals, etc., were all repaid pre-year end. The only elements that are reflected in that was the deferred dividend and the subsequent repayment of the furlough monies. So combined, they were around about 1.5 million. But yeah, very, very easy, comfortable balance sheet that we have now. If I move on to the cash flow statement on 14, please, thank you. I think the picture really flows through from the comments on working capital in the balance sheet. From a similar EBITDA position to last year, we've reduced debt by 10.6 million, driven by those working capital movements. As I said, we would expect some normalisation on that, but not to the previous levels. And I think I can pass over to Simon now.
Okay, thank you, Graham. So page 15. Thank you. Good morning, everybody, and thank you for coming on. Well, as you can see, it's been a bit of a year, a bit of a roller coaster, but I think we have done fantastic. Before I start on the strategy and outlook, I would just like to say how proud I am of our colleagues. The response, the hard work, the dedication, it's just been unbelievable. The team has gone from strength to strength in such a really tough time, and we've really found who our great members are, and we've got so many of them. They've all performed above expectations for us. So a real big thank you, first of all, to the team. I mean, you can see by the investment we've put over the last 10 years in our graduate scheme, it's paid off, because everyone just got really stuck in. Even people that have been working in the offices, if they had to go into work into the warehouse to help us with online, every single member got stuck in to help us survive this COVID problem, and we've done it. So it's been a very, very interesting 9 months with the team. So strategy remains unchanged. It's more relevant than ever, actually. We focus on the winners of retail. That's what we do. So supermarkets, and they've been big winners this year. Our brands consistently resonate with the consumer in the supermarket. And the more of our brands keep going in there, Beldray, Salter, and Tempo, Russell Hobbs, the more they keep buying into it, and the more the retailer keeps buying off us. This isn't just happening in the UK as well now. This is also happening in Europe. So Kaufland, which is one of the biggest supermarket retailers in Europe, we're getting very strong orders off them and very strong repeats, and they love our innovation. Lidl, seen as a game changer. Aldi, Riva, they've got 3,000 stores in Germany. And a new store we've only just taken on, we've taken our first orders, awaiting our second, is Biedronka in Poland. They have 3,000 stores. So if you think about how much bigger that is than the UK supermarket, the size of the orders are much different to what we get in the UK. So it's very exciting for us. And we do see over the next 18 months, supermarkets to take over the discounters as a percentage of business. Our products, our innovation, our quality, our packaging, supermarkets are taking it on board much, much faster. Online, we're homing into our target now of 20%, which is what we brought out at IPO. I would say probably after Christmas, we would have to bring out a new target, because we'll be hitting that 20% target. This is such an exciting segment of our business, because it's retail. It's a retail side. The margin is much better. Cost to serve is higher, but margin is much better. And there's so much growth in the online business. We're only really in the UK. So it's now for us, it's about opening these sites in Europe, in France, in Holland, in Germany, in Spain, which we have opened. And now we're going to start all the marketing work around those markets. So very exciting on the online business and growth. International, which wasn't talked about much when we first IPO'd, but this has grown dramatically. We opened our 10,000 square foot showroom in Cologne 18 months ago. Our staff now are there. There's 4 permanent staff selling. And again, the volumes that we are seeing, the interest from international European retailers is very good, because our product is different to what's there already. And what retailers always look for is something different. So we're not trying to sell to everybody now in Germany and France. We've selected our retailers that we want to be in, and that's who we're focusing on. But we see from being very small on IPO, we see international going to 50% of all of our turnover over the next 18 months. And Germany is already up 50% now. So outlook. As you know, conditions in the UK and Europe remain challenging. They're both going back down into lockdown. But nonetheless, current trading is in line with expectations. The FY21 order book is ahead of this time last year, and we are confident about the future. It's a great business. So thank you very much. And is there any questions?
Question here around the import duty variation expectation post Brexit. So perhaps an opportunity to talk a little bit more around your stocking and so forth. Do you have EU officers for trade in the region?
Yeah, we have. Obviously predicting what's going to happen after Brexit is pretty tricky at the moment. But the tariff schedules that we've seen means that most of our products at the moment attract the tariff. The average tariff is sort of between 3 and 4%. That's for product coming into the UK. For product going forward, the tariff schedules we're seeing for products coming into the UK market will be, most of our products will have no tariffs at all. So for importation into the UK, it looks like, and I'm kind of touching lots of wood because I think, you know, who knows what a deal will look like and what impact that might have if there is a deal. But it looks like on a sort of base case scenario, our tariff cost into the UK will drop significantly. We of course have business that does go across the channel back and forth. We import some product from Europe and we export some product into Europe. Although overall it's a much smaller proportion of our business. Most of our European product goes straight from China into mainland Europe, and that won't change, and the tariff treatment of that product won't change. So I think we feel cautiously. We think on the tariff front we're not going to have too many issues. Net, we think we'll be a beneficiary, but you know, we need to see what any deal looks like. But that's where we think we'll be. I think that from an administrative point of view, we already have branches in Holland and in Germany, so we're structurally set up to continue trading in Europe on the same basis as we're doing now. So I think where there will be some disruption will be some of our products, particularly, say for example, into Amazon Europe, crosses the channel. There'll be a tariff cost to that, and I suspect around 1st of January there might be some disruption as well. So what we'll probably, I mean, we're not worrying too much about it because it's a relatively small proportion of our business. But around that kind of end of December, January, if there is no deal and Kent turns into a giant truck park, then we might have to just turn the taps off for 4 to 6 weeks and let that settle down. But overall, we think on a no deal basis, which I think is still worst case, we're looking at a sort of a perfectly manageable situation.
Okay, well, I mean, there's a question there which asks how it would affect revenue and profitability. So I think the answer is minimally. Minimally, yeah. Excellent. Okay, next up, current conditions. What's your experience with working capital? Are your larger customers taking longer to pay, and is there a risk of impairment, especially as some of the smaller customers face difficulty? And are your credit insurance premiums staying stable?
So you've gone, Graham. You take that one.
I was just going to say we did see some increase in debtor days over the lockdown period, but we managed that on a case by case, customer by customer level, such that sort of the year end that was all resolved. Any extension was cleared, and our debtor days were back down within our normal range. We're very cautious on credit insurance. I think we refer to sort of maintaining average insurance of high 90s. I think it was around 90%. I think it was 97% this year. So we take a very small proportion of risk on our insurance levels, and there's been a small increase in premium rates, but nothing too significant.
I think the write-off, given that we went through that period where a number of, quite a few of our customers had stores closed, we didn't really. I mean, our bad debt write-off in the year, Graham, was still pretty modest, wasn't it, overall? Yeah. So we did manage that, and it wasn't without challenge. Obviously, if you've got customers with stores that are closed and no revenue coming in, they don't tend to be particularly quick to pay, because they don't have the cash themselves. But we did navigate that period with hardly any level of bad debt write-off overall.
Okay, thank you both. So we touched on the redevelopment of the mill and the 1.8 million that you will be investing in upgrading it. The mill owned by the directors, how would that be then reflected going forward? Would there be a lower rent to pay by UP?
Well, the mill is owned by Barry Franks, who has just recently stepped off the board, but he was a co-founder with Simon. We agreed a 10-year fixed rent deal with Barry. So just to put into context, we pay less than £1 per square foot per year. So not exactly London rate rents, but we've fixed that now through to the ends of the current lease. So it's a pretty, well, in my opinion, it's a pretty good deal. So hopefully our shareholders agree.
Is that 10 years left from now, Andy?
Graham, I can't remember. It is 10 years from now, isn't it?
It was signed in January. So
yeah.
Okay, thank you. And just perhaps a little bit of a historical one here, but someone says previously there were 2 mills in Oldham. What happened to Heron, and does it reflect a reduction in anticipated UK volume?
No, Heron is our main distribution centre, so that's very much in use. And in fact, it's a bit like an ant's nest. You know, it's very, very busy. Very, very busy distribution centre. So yeah, no, that's very much still there.
Great. Looping back around to China, obviously, you touched, Simon, on how you're looking at other opportunities for manufacturing. But someone's asking here, the air freight costs from China have soared. Has the sea freight cost gone up significantly as well?
Yeah, air freight started right at the beginning of COVID. It really did soar like 4, 5, 6 times as much. The freight was a bit slower, but now, yes, it has started to increase. The ships are very, very full, and they're also just taking capacity out as well. They're just taking 10% capacity. So yes, we are paying more for freight, but we've got 2 very strong relationships with the big freight forwarders. So we are getting on the ships, and we are on it where we can see our competitors not getting on the ships. So yeah, it's definitely one to watch at the minute.
Glad you're getting the slots in there. Right, a couple we've had in on email. Let's start with, how has Intempo traded since the year end?
Well, as you can see, it's not traded as strong as normally. And this is due to obviously one of our biggest customers on the brands not doing as well. But the Intempo, the speaker market has changed dramatically. We did a lot of millions and millions of speakers, and now you can buy a Google or Alexa speaker for £20. The quality is excellent. They're selling it less than cost just so they've got Alexa in your house. So to compete on that market, we've really had to come out of it. What we are focusing now on, and it's done very well, is the gaming market, the headphones, the keyboards, the speakers, and also the TikTok market, because all the lighting and the cameras around TikTok is massive. So we are seeing quite a big upside on that sort of product. So this is what we do. We sometimes are the saturation of the product area. There's the brands bring down their prices. We move on to the next.
Everyone wants
I think Hannah, to add to that, we do see the sort of key drivers of growth being, SDAs, housewares and laundry, and perhaps for the moment, because of certain sort of structural challenges, audio less so. But the reason why we have a kind of well diversified sort of product base is that this is what always happens. Products go through cycles, and what we've learned to do is change our focus as consumer demand changes. And I think for the moment, audio is going to be a fairly tough area.
Okay, well then, if we look across to Europe and the growth that you are seeing in Germany, is it those 3 divisions that are driving the growth there? Which products are selling well?
Cookware is selling extremely well. Our Belgio vacuum cleaners are very strong. SDA, very, very strong. Audio and Intempo is still strong out there. So, and don't forget, we're very new and we're very small, so we're just on the beginning of the journey. Even though it's growing so fast, we're still on the beginning of that journey. But they're mainly the 4 categories.
Okay, thanks. Perhaps a bit of a bigger picture now. How do you feel as a team? You know, obviously lots of gloom out there at the moment. Are you feeling confident or cautious? And are you looking forward to investing for the future, or do you feel the need to be a little more defensive?
I think I'll go first. I think I'm sure Simon will add to it. He's the entrepreneur. I think we are feeling a bit more risk on than risk off, which might seem weird as we enter a lockdown. I think, you know, we're financially strong. We've seen it's obviously been a hugely sad time in terms of the impact it's had, you know, on the country. But as a business, in many ways, it's been beneficial. You know, we've kind of taken the business apart brick by brick and put it back together. That's what lockdown forced us to do. We've had to look in every corner of the business, and that's led to, I think, an acceleration of our strategy. Changes that might have taken several years have happened in a few weeks or months. So I think that the 2020 has been a challenging year, but also a year of huge change for our business and acceleration, as I say, of the things we were doing anyway. So I think, you know, for example, at the moment, we've kept it's recruitment season for graduates, you know, and we've kept that going. You know, I mentioned earlier on, we kept our product development going when others perhaps were more fearful, and you know, we've kept close to our customers. So we're not going to go crazy because we are a relatively cautious management team anyway. But we feel that we feel that we should continue to invest in our people, continue to invest in our product development, and continue to invest in the relationship we have with our customers. Do you have anything to add to that, Simon?
I'm not supposed to say this, but I feel really confident. I feel really confident because I've seen what my team have done. I've seen how they've all come together. I've seen people grow even more than so fast into the business. I feel confident because I see how the retailer now sees us and how important we are to the retailer, and how that means we've got to do an even better job to the retailer with delivering on time a value product that's packaged beautifully, that flies off the shelf. And I'm excited, but I'd like to see everyone settle. I'd like to see the jobs, or I'd like to see what happens with the rest of the UK, because obviously it's going to be a very, very tough 12 months for a lot of families and a lot of people. But I think that's what everyone should all be focused on for the next 12 months, making sure that everyone else is okay. And we're doing that already in Oldham.
Well said, Simon. If then perhaps leading on from that sort of bigger picture view, we took a look back 4 years ago to when you first came to market, and the business that you are today. What do you think the key changes have been over that period?
So I think in Chris's notes, there's a 2 pie charts which show the sort of revenue split by pillar, which I knew it already, but it was interesting to see it presented in that form. And I think what that and Graham sort of added to that earlier on with his analysis of discounts has gone from broadly 60% to 40% of revenue, and supermarket of online have gone from less than 20 to 40. So if it's a much better balanced business, much more diversified, much less customer concentration. It's got I think greater avenues for growth in terms of it, particularly with international and online, where you can it's almost kind of the sky's the limit, really. So I think the business, and I think all that adds up to a much better quality of earnings. And I think, and again, I think this year has very much illustrated that, because we did lose, a large number of our customers did close, and we weren't able to supply them. But what we were able to do is shift our focus. So, we were able to kind of focus a bit more on online during that period. So that diversification very much presented itself during that period when elements of our business did close, but other elements were there to take over and to mitigate that loss of revenue. So I think what we have now is much better quality business, better quality of earnings, and with more scope for growth going forward.
Okay then, well, this probably in terms of brand development over that time period, someone's asked here, they feel that the licensed brands have been very strong in full year 20 compared to your owned brands. Are there any special factors behind this strength, or does it in fact reflect the relative weakness of the brands that you own?
No, I think Beldray, as Graham said before, Beldray, which is our #1 brand, is it only grew by 1.5%, but if you take a longer view, it's grown very, very rapidly over the last sort of 5 to 10 years. I think it was more. I think Graham said it was more affected by some of the closures, perhaps, but fundamentally, it's an absolute brilliant brand, and Simon always presents it as a kind of an everyman brand. It seems to, wherever we put it, it seems to sell. Salter, for example, fantastic brand, but they don't like it in Europe. And it's pretty much a supermarket brand, so it's a bit narrower. Beldray is a brand that seems to, wherever we put it, it seems to do really well, including Europe. And it's not like Europe had any prior knowledge of Beldray, so they weren't sitting there waiting for Beldray. So I think if you said to me what's our best brands, it would always, Beldray's our best brand by quite some distance. I think we do want to see better diversification across the brands. That's why Salter and Russell Hobbs are licensed. That licensed brands come with certain risks, particularly on renewal. The Salter is licensed through to 2024. Russell Hobbs till 2023. We expect them to be renewed like they always have been. But we want to bring Progress and Clean Easy to the top table now, and we've learned a lot about how to cost effectively market brands. We didn't know anything about it 10 years ago when we started our journey with Beldray. We've learned a lot over the last few years in terms of use of social media, use of influencers, and maybe also sort of celebrity endorsements. So we're and also use of the marketing tools that Amazon presents us with. Amazon gives you a suite of very sophisticated and easy to use marketing tools, which we're going to take full advantage of in pushing those two brands up the ladder.
Well, I do have a last question here then on Clean Easy. Obviously, one gentleman used to get a leaflet drop with the products, but he's so those have disappeared from his front door mat. So how is the brand now being marketed?
So Clean Easy, as I think many of you will know, was a retail brand. It was a retail catalogue brand, and it went into administration, I think, in 2018. We bought it out of administration for a very reasonable price, but we've changed it from a retail brand into a product brand. So that's why he's not seeing the leaflets anymore. It's because we've looked to use Clean Easy, because of those leaflets had built a very high awareness rate amongst the consumer. So when we've tested this, we've seen awareness rates of 75%. So we've looked to take that brand awareness, but move it into being a product brand rather than a retail brand.
Okay, and one more just popped in. Given the breadth of the product portfolio, have you considered going direct to the consumer, which I suppose is sort of what you're doing with Amazon, but using perhaps via Shopify or, well, an alternative e-commerce provider?
So we've, for the moment, we're going to focus on using, in terms of our online direct, it's going to be about platforms. So rather than trying to build our own proprietary web offer, and the reason why we're doing that is we just feel when it comes to general merchandise, people want to shop on Amazon, for example. So that's where we need to be, and I think we could spend a lot of money and waste a lot of money trying to build our own website presence. Now, that might evolve over time, but for the foreseeable future, it's going to be about utilizing other people's platforms to sell our products.
Well, that's it for today. So thank you to the three of you. Best of luck for the coming lockdown and the next 6 months until we hear from you next. Thank you again.
Thank you, Hannah.